everyone, welcome back to the deep dive. Today we're going to try to untangle something that I think a lot of us find kind of scary, um, investing. And building an investment portfolio. It sounds very, I don't know, very Wall Street, right? But honestly,
Yeah.
you don't have to be a financial expert to start making smart choices about your money.
Right.
And that's what we're going to get into today. How to build like a simple, effective portfolio, something that can grow over time. And we have some really cool articles and research to help us out today. Plus, like I was saying before we started recording, I have a ton of questions about this stuff.
Yeah.
So disclaimer time, full transparency. My early attempts at investing were, let's just say, not pretty.
Okay.
I kind of felt like I was just throwing money at random things and hoping for the best. And I learned the hard way that diversification, not putting all your eggs in one basket, is super important.
Yes, sir.
So let's just start with the basics, right? Like, what even IS, an investment portfolio. When I hear that term, I immediately picture like a bunch of guys in suits on Wall Street, yelling into phones and looking at those flashing stock tickers.
Yeah, I mean, it sounds a lot more complicated than it actually is. It's really just a collection of assets, different things that you own, with the goal of, growing your wealth over time. So instead of putting all your money in one place, you spread it out, you diversify, and that way you're managing your risk and increasing your chances of reaching those goals.
Got it. So it's about spreading the risk, not putting all our eggs in one basket. And our source material really emphasizes like keeping it simple, especially when you're just starting out, right? We don't need to be spending all day, every day, watching the stock market, trying to become like a day trader or something.
No, not at all. That's not what this is about. Simple portfolios, they're all about broad diversification.
Yeah.
That's the key. Without getting lost in the weeds, trying to pick individual stocks or constantly making changes. It's about consistency, contributing regularly, keeping those fees low, and then letting the magic of compounding do its thing over time.
Okay, compounding.
Yeah.
Now, there's a word that always makes my eyes glaze over.
Oh, yeah.
Is there a way to explain that without needing a math degree?
I think so. Imagine a snowball, right?
Okay.
Rolling down a hill. It starts off small, but as it picks up speed, it gathers more and more snow, getting bigger and bigger. That's kind of compounding in action.
Mm-hmm.
Your returns, they generate more returns, and then those returns generate even more returns, and it just kind of snowballs over time.
Okay, I'm starting to see the picture here.
Yeah.
So the earlier you start, the bigger that snowball gets,
Okay.
right? So let's break down those building blocks of this simple portfolio. Our source material talks about stocks, bonds, and alternative assets. Let's start with stocks. What exactly am I buying when I buy a stock?
So when you buy stock, you're essentially buying a little piece of ownership in a company. Like, let's say you buy stock in a company that makes electric cars. Now you get a stake in their success. If that company does well, grows and sells a lot of cars, the value of your stock should go up.
So I could be like part owner of some of my favorite companies.
Yeah, essentially.
That's pretty cool. But I also know that the research talks about stocks being like volatile.
Mhm.
What does that actually mean?
Yeah, so volatility just means that stock prices, they go up and down, sometimes a lot. And there are all kinds of things that can affect that, like how the company's doing, the overall economy, what people are feeling about the market. It's like a roller coaster. There's going to be highs and lows.
Yeah.
The key is to not get caught up in the day-to-day changes and focus on that long-term trend.
Buckle up. Okay. But I guess that's where diversification comes in, right? And the research mentions index funds and ETFs for stocks. What are those in like normal people terms?
Sure. So think of index funds and ETFs as like baskets of stocks. Instead of putting all your money in one or two companies, you're spreading it out across hundreds, maybe even thousands of companies. That way, you're spreading that risk, getting exposure to a whole bunch of different companies all at once. So like an S&P 500 index fund, it would track the 500 biggest companies in the U.S.
So I'm buying a slice of the whole stock market pie.
Yeah, exactly. And it takes the pressure off you. You don't have to try and predict which companies are going to do well.
Yeah, that sounds way less stressful. Okay, so that's stocks. What about bonds? Where do those fit into this whole thing?
So bonds, they're a little different. It's like lending money to a company or to the government, and they pay you interest for that loan. Bonds are generally considered safer than stocks. They tend to be less volatile. So it's a good way to add some stability to your portfolio, especially, as you get closer to retirement.
Okay, so bonds are like the reliable friend in my portfolio, and stocks are the ones that might, surprise me. hopefully in a good way.
Right.
So our sources also mention these things called alternative assets.
Yeah.
What are those, and do I, as a beginner, need to worry about them?
So alternative assets can include things like real estate, maybe owning rental properties or investing in REITs,
Mm-hmm.
commodities like gold or oil,
Okay.
and even things like private equity. They can be a way to diversify even more,
Yeah.
but they can be complicated.
Okay.
They often require, more knowledge and more expertise.
So maybe not something to jump into right away.
Right. I'd say get a good grasp on stocks and bonds first. They're really like the foundation.
Okay. Yeah. Solid foundation. Makes sense.
And then once you're comfortable with those, then you can start to look at other options.
Okay. So let's talk about how to actually build my white portfolio step by step.
All right, let's do it.
First thing, our sources say setting clear financial goals.
Yes, absolutely.
I mean, it makes sense, right? You wouldn't just get in your car and start driving without knowing where you're going.
No, that's
Yeah.
exactly right. You've got to have a destination in mind.
Yeah.
So with investing, your goals, they're going to determine your strategy, how much risk you're comfortable with, and how long you plan to invest. So are you saving for retirement? A down payment on a house? Maybe you want to start your own business? Each of those goals is going to require, a different approach.
All right. Goals first. Check. But how do I even know how much risk I'm comfortable with?
Right. So that's where understanding your risk tolerance comes in. It's not really about knowing all the financial terms or the jargon. It's more about understanding how you feel about the potential ups and downs in the market. So are you the kind of person who loves roller coasters?
Oh, God, no.
Or do you prefer, a nice calm train ride?
I'm definitely a train ride kind of person. I don't need those drops and twists when it comes to my money.
That's a great starting point. That tells us you're likely more risk averse, right?
Right.
And that's going to influence the types of investments that make sense for you and how your portfolio is structured. And remember, risk tolerance can change. Like as you get closer to retirement, you might not be as comfortable with big changes in your portfolio's value.
Okay, so it's not set in stone.
Exactly.
Okay, so we've got our goals. We kind of have a sense of our risk tolerance. What's next?
So the next step is figuring out your asset allocation, which is basically deciding how to divide your money between different types of investments, like stocks and bonds. This is where that don't put all your eggs in one basket principle comes in a big way. The right mix, it's going to depend on your goals, your timeline, and of course, how much risk you're comfortable with.
Okay, so how do we actually figure out the right mix? Is there like a magic formula or something?
There's a good rule of thumb that a lot of people use, a good starting point. It's 100 minus your age. And that number, that's the percentage you should have in stocks. So let's say you're 30 years old.
Mm-hmm.
That means 70% of your portfolio would be in stocks, and the other 30% would be in bonds.
Okay, that's pretty straightforward. But what if I'm younger, but I still feel nervous about putting that much into stocks?
Totally understand that. And this rule, it's just a guideline. It's not set in stone. So if you're more risk averse, you might adjust it a bit, have a higher percentage in bonds, even if you're younger.
Okay, so it's about finding that right balance. Got it. So
Yeah.
far, so good. So we've got our goals, we've figured out our risk tolerance, we've even got a basic idea of how to allocate our assets. But how do we actually start investing? How do we choose the right things to put in our portfolio?
So that's where those index funds and ETFs that we talked about earlier, they really come in handy. Remember, those are like baskets of stocks or bonds that track specific market indexes.
Yes.
So they're a simple, low-cost way to get diversification without having to pick individual stocks yourself.
Right.
No need to be a stock picking expert.
Okay, less stock picking stress, definitely a good thing. But there are so many different index funds and ETFs out there. How do we choose the right ones?
Okay, well, let's look at some examples. For a broad exposure to the U.S. stock market, there's the Vanguard Total Stock Market ETF, ticker symbol VTI, or the SPDR S&P 500 ETF, SPY. If you want to add some international exposure, diversify globally, the Vanguard Total International Stock Market ETF, VXUS, is a good one. And for bonds, the Vanguard Total Bond Market ETF, BND, is a popular choice.
Wow, that's a lot of letters.
Yeah.
So basically, the takeaway here is to choose a few funds that are diversified and that cover the asset classes we've decided on.
Exactly. Keep it simple. A handful of broad market index funds, or ETFs, is really all you need for a solid, well-diversified portfolio.
Okay. This is definitely starting to feel a lot less intimidating than I thought it would. So we've got our diversified funds all picked out. Now, how often do we buy them? Is this like a one-time purchase, or is there a smarter way to do this?
So that's where this concept of dollar cost averaging comes in, which is a really great strategy, especially for beginners. Instead of trying to time the market, figure out the perfect moment to buy, which is honestly impossible, you invest a fixed amount of money at regular intervals. Maybe it's monthly, maybe it's quarterly.
Well, that sounds a lot less stressful.
It is.
So instead of trying to guess when to buy, I'm just consistently investing the same amount over time.
Exactly.
Why is that better?
Because it smooths out those bumps in the market, right?
Right.
You're buying when the market's high, you're buying when the market's low. So over time, you're averaging out your purchase price. And it also, I think, just as importantly, it takes the emotion out of investing, which I think we'd both agree is pretty key.
Yeah. If I saw my portfolio value drop right after I put a bunch of money in, I would probably freak out.
Exactly.
Yeah.
And that's what can lead to people making not so great decisions.
Yeah.
So automating that process, making it consistent, can really help you stay on track and not react emotionally to those short-term market swings.
Speaking of making it easy, can I actually automate this dollar cost averaging? Because I got to be honest, I'm probably not going to remember to do it every month.
Absolutely. Most investment platforms, they let you set up automatic contributions.
Okay, good.
So you can choose how much you want to invest and how often, and then the platform just handles it for you. You set it and forget it.
Okay, this is really starting to feel doable.
Good.
Simple, diversified, and consistent. Our source material also includes a few example portfolios to show how all this fits together. Want to
Okay.
walk me through those?
Sure. So they've put together 3 sample portfolios: aggressive, balanced, and conservative. And they're designed for different risk tolerances and time horizons.
Okay, let's start with the aggressive portfolio.
Yeah.
Who's that kind of portfolio for?
So the aggressive portfolio, it's really geared towards investors who are, younger, have more time to let their investments grow, and are comfortable with a bit more risk. Because with more risk, potentially comes more reward. It usually follows an 80-20 split, with 80% allocated to stocks and 20% to bonds.
So most of it's in stocks.
Yeah.
And within that 80% allocated to stocks, how's that typically divided?
So a common way to do it is to allocate about 60% to a U.S. total stock market ETF, like VTI, which we talked about earlier. That gives you broad exposure to the U.S. stock market. And then to add some international diversification, the remaining 20% could go to an international stock market ETF like VXUS.
So even within the stocks portion, we're still diversifying.
Exactly. Different regions, different companies.
Oh, okay, got it. And then the other 20% of the aggressive portfolio, that's in bonds.
Yeah, using something like the total bond market ETF, BND,
Right.
it helps to add a little bit of stability, even in a portfolio that's mostly stocks.
Okay. It's really helpful to see how all this actually comes together. What about the balanced portfolio? What makes that different from the aggressive one?
So the balanced portfolio, as the name suggests, it's more, balanced. It's usually a 60-40 split,
Yeah.
60% stocks, 40% bonds. For that stock portion, you could do something like 40% in an S&P 500 index ETF, like SPY,
Okay.
and then 20% in that international stock market ETF, VXUS. And for bonds, you could stick with a broad market bond ETF, like BND.
So the balanced portfolio's got a bit less emphasis on stocks and a little bit more on bonds.
Right, exactly. So it's a bit less risky overall than the aggressive portfolio.
Makes sense. And finally, we have the conservative portfolio. Who's that typically for?
So the conservative portfolio is for people who really prioritize safety.
Okay.
They're not comfortable with a lot of ups and downs in their portfolio. This might be someone who's nearing retirement or someone who just has a lower tolerance for risk in general.
Mm-hmm.
And it's usually a 40-60 split, 40% stocks, 60% bonds. Basically the opposite of the aggressive portfolio.
Got it. So bonds are taking lead in this one. How would the stock portion be divided in a conservative portfolio?
You can do 30% in the U.S., total stock market ETF, VTI, and then 10% in that international stock market ETF, VXUS.
Okay. And then the rest in bonds.
Exactly. Still using that broad market bond ETF like BND.
This is super helpful. I can really see how these different asset classes, how they can be combined based on my, my own risk tolerance and my own goals. This is really starting to feel simple. But what happens after I've built my portfolio? Can I just set it and forget it?
Well, not quite. I mean, a simple portfolio is designed to be, relatively low maintenance. But investing, it's not really a one-time thing. It's more like a journey. So your portfolio, It needs a little bit of attention every now and then to make sure it's still on track to help you reach your goals.
So even with a simple approach, there's still some work involved. What does that look like?
So the key things are monitoring your portfolio and rebalancing it when you need to.
Mm,
And when I say monitoring, I don't mean like checking it every day, obsessing over every little change.
okay.
It's more about like checking in regularly, making sure your investments still make sense for you, for your goals, for how much risk you're comfortable with.
Got it. Checking in, not obsessing. What about rebalancing? What is that exactly? And why is it so important?
Okay, so imagine, you've got a car, right?
Mm-hmm.
And over time, some parts are going to wear out faster than others. Rebalancing your portfolio, it's kind of like tuning up your car's engine, making sure everything is running smoothly. Because what happens is your investments, they're not all going to grow at the same rate. So your portfolio, it can kind of drift away from that target asset allocation we talked about earlier.
So, like, what if my stocks have been doing really well and they've grown way faster than my bonds?
Right, exactly. So now your portfolio might be, a lot heavier on stocks than you originally planned.
Which means I'm taking on more risk than I might be comfortable with.
Right, exactly. So rebalancing, it's basically selling some of those investments that have, done really well and using that money to buy more of the investments that haven't grown as much. It's bringing your portfolio back into balance, back to that target allocation.
So, in the example we were just talking about, I would sell some of my stocks and use that money to buy more bonds.
Exactly. And it might feel a little weird, right? Selling something that's doing well,
Hmm.
but it's really important for managing that risk and making sure your portfolio is still aligned with your plan, your goals.
Okay, that makes a lot more sense now. How often should I be rebalancing my portfolio? Like, is this a monthly thing?
Not necessarily. Most people rebalance once or twice a year,
Right.
or whenever their portfolio, gets too far off track from that target allocation.
Yeah.
And a lot of investment platforms, they have these tools, these automated rebalancing tools that can actually do this for you.
Oh, that's great. Saves me a lot of work and stress. Okay, so we've talked about a lot today. The basics of building a simple portfolio, setting goals, figuring out how much risk we're comfortable with, asset allocation, choosing those diversified investments, and even strategies like dollar cost averaging and rebalancing. This feels a lot more manageable now, but I'm kind of curious, what are some of the common mistakes people make when they're managing their own portfolios?
I think one of the biggest mistakes is letting your emotions, your feelings get in the way.
Yeah.
The market's going to go up, it's going to go down. And it's easy to kind of panic and sell everything when things are looking bad or get, super excited and buy a bunch of stuff when the market's doing really well. But reacting emotionally, it usually leads to bad decisions.
Yeah, I can definitely see myself doing that. Like, especially if I see my portfolio value going down. It's different when it's, your own money on the line.
Right. And that's why it's so important to have a plan. You
Yeah.
know, remember what your goals are, why you chose those investments in the first place. A diversified portfolio, it's built to handle those ups and downs.
Yeah.
So just trust the process. Be patient.
Easier said than done sometimes, but I'm starting to see how important that discipline is, especially when things get a little crazy in the market. What are some other common traps we should be aware of?
Another big one is chasing performance. We all want to get in on the next hot stock or the latest investment trend, but just because something did well in the past doesn't mean it's going to continue to do well.
Oh, yeah, the shiny object syndrome. It's real.
Right. So just stick to that diversified approach that we talked about and resist the urge to jump on every bandwagon that comes along.
So discipline, no emotional decisions, and don't chase the hot stocks.
Okay.
What else?
And just never stop learning.
Oh, yeah.
Educate yourself about investing. There's so many resources out there. Don't be afraid to ask questions. Read, research, stay informed about what's going on in the markets and the economy. The more you know, the more confident you'll feel.
This has been so helpful.
Good.
I mean, we've covered a lot today. Building a simple portfolio, keeping it in check, even some of the psychology of investing. I feel like I'm actually starting to understand this stuff.
That's great. Remember, it's a marathon, not a sprint.
Yeah.
Just stay consistent, be patient, and keep learning. That's the key.
Before we wrap up, something's been on my mind. We've been talking a lot about building a portfolio for long-term growth, but what about shorter-term goals? What if I'm saving for a down payment on a house and I need that money in a couple of years? Should I be investing that money differently?
Yeah, that's a great question. And the answer is, it depends.
On what?
Well, a lot of the same principles still apply. Diversification, managing risk, that's all still important. But your investment choices, how you approach things, it might need to be adjusted depending on, how soon you need that money.
So for a goal like a down payment, something that's relatively short term, should I be less focused on, huge growth and more focused on just protecting that money, making sure I don't lose it?
Exactly. Since you need that money soon, you probably don't want to risk it in the stock market,
Okay.
especially if you need it in, less than 5 years.
Huh.
Because, well, the market can be unpredictable.
Yeah, that makes sense. I wouldn't want to risk losing my down payment savings right before I need them. So where would you recommend putting that kind of money? What are some safer alternatives to stocks for like shorter term goals?
Sure. So there are a few options. You could consider, a high yield savings account
Okay.
or a money market account
Mm-hmm.
or even a short-term bond fund.
Okay. What are the differences between those? How do I choose the right one?
So high yield savings accounts, they're probably the safest option.
Okay.
They offer, decent return on your money, not the highest, but decent, and they're FDIC insured, which means your money is protected.
Okay. So that's like the safest bet.
Yeah, pretty much. Money market accounts, they're similar to savings accounts, but they might have, slightly higher returns. And they often come with check writing privileges.
Okay. What about those short term bond funds? Are those riskier than the savings account options?
So short-term bond funds, they invest in bonds that mature in, 1 to 3 years, which makes them less volatile than bonds that have longer maturities. They usually have a higher return potential than savings accounts or money market accounts, but they do come with, a little bit of risk.
So it's a trade off, higher potential return, but a little bit more risk.
Exactly. It all depends on your time horizon.
Got it. So if it's short term and I need the money soon, I might play it safe.
Right.
But if it's for the long haul, like retirement, I can afford to take on a little more risk for the chance of higher returns.
Exactly. You got it.
Mm.
And of course, the exact investments you choose, they're going to depend on your own situation, your risk tolerance, your financial goals, all that good stuff.
This is making so much more sense now. I feel a lot more confident about, actually making decisions about my own investments, not just for long-term stuff, but even for those shorter-term goals too.
That's great to hear. And remember, knowledge is power.
Yeah.
The more you learn, the better equipped you'll be to make those smart decisions.
Any other final tips or advice before we wrap up today?
If you're feeling overwhelmed or if you have any complex financial situations, it's always a good idea to talk to a financial advisor.
Yeah, sometimes it's good to have a professional in your corner.
For sure.
Well, this has been fantastic. We've learned so much
It has.
from the basics of investing to, some more advanced strategies.
Yeah, it's been a pleasure. Remember, investing, it's a journey. Keep learning, keep exploring.
Wow, I feel like we've really demystified investing today. It's amazing how a simple, consistent approach can really make such a big difference over time.
Yeah, it really can. And the most important thing is just getting started, taking that first step. You don't have to start big. Even small, consistent investments, they can add up over time thanks to the power of compounding.
And I think that's one of the biggest takeaways for me. You don't have to be like a Wall Street genius to be a successful investor. You just have to understand those basic principles, put a plan in place, and stick to it. Be disciplined.
It's true. Investing, it really is for everyone.
Mhm.
It's about taking control of your financial future and building wealth, on your own terms.
We've definitely given our listeners a lot to think about today. Anything else you want to leave them with before we sign off?
Just keep learning.
Yeah.
There are so many great resources out there,
Yeah.
online, in libraries. There are even community workshops sometimes. Just keep exploring. Stay curious. Remember, it's a journey, not a destination.
Well said. We hope this deep dive has empowered you to start building your own simple, effective investment portfolio. And remember, we're not financial advisors, but we're always here to spark your curiosity and get you thinking about your financial well-being. Thanks for joining us on the deep dive.